Hi again. In this video, I'm going to be talking about my trade on Intel, ticker INTC. Now, Intel Intel was basically doing nothing all day, and then out of nowhere, it had this parabolic spike, on a tweet or two tweets. And let's see this tweet. So this tweet came out, and it said that New York-based fund has amassed a nearly 1 billion stake in Intel, and then there's a second one that followed. That's this one where exclusive Third Point LLC calls on Intel Corp to explore strategic alternatives later to the company. So, because of this tweet, the algos went nuts. It basically went $1 up in about 1 minute. And you can see from down here that I use like Tick instead of volume, because Tick basically shows you the exchange between a trade. So it'd be a trade from one person to the next person to another person, buy and sell order, instead of volume, because volume just tells you how many stocks being exchanged. So I like to use Tick instead of volume. So if you notice that this tick right down here on the bottom panel is way more than anything else, plus the stock price jump, basically explode. Usually if there's a high tick, there's high volume. I mean, sometimes there's like low volume but high tick. But usually they're pretty much the same, close the same. But I like to use tick. So when the stock jumped $1, there's, in the options contract, the volatility just spikes, crazy spikes. So when you get that spike, the option contract could be out of whack. The spreads go so high and it just goes insane. And with that big spread, it's kind of tough to get in and out, because if you get in at the ask, then if this stock pulls back, you'll lose a lot of money. So it's really dangerous to get into these kind of plays. But since there was a tweet and then the algos was going nuts, I decided to just get in for YOLO. And you see on here, I got in at 12:28 p.m. and the contract price was at $58 for the 48 call contract. So I got in around right here. Let's see. So I got in right around here, right before it broke above 48. So when you got it right around here, it spiked all the way up. So my contract was basically running really fast, all the way up to here. Now when it got up to here, the contract was worth about 130. So in about 2 minutes, it went 100% up to here. So I held it thinking that it would keep on going. But then it pulled back. When it pulled back, instead of like closing it out at 130, it pulled back, and that contract was basically worth around 75, right? So I was afraid, usually you would sell out the contract and then just forget about it. But I was waiting for more of a move, so it pulled back down and it came back up. So when it came back up, I decided just to get out of here. So when I got out of here, I sold the contract for $121 for the contract. So it was only about a 3 minutes of 3 minutes play. But you can see that this contract, the stock actually kept on moving up with the ticks and the volume stabilizing and kept on going. So when it got up out to here, this contract was worth about $200. Well, more than 200, 250, around 250. And then it came back down. Now, because of the spike in volatility, you don't know that this thing's gonna get destroyed and come back down, or kind of chop around all the way down here. So if it chops around, if it comes down, that contract could be underneath what I paid for it, or when it just chops around like that with the low volatility going down, those contracts would just die off, basically die off like crazy. So I want to keep my profits, and I don't want to like give it back or let it fade to nothingness. So it's just better. It's just a better trade just to get out, take your profits, get out, and it was over 100% win. It was like 128% win. So yeah, I could have had maybe like a 400% win up to here, but what was that? 400, 300, something like that. But it's just safer just to take your profit, get out of there, and get another play, do another play. So, okay, that's my trade on Intel, ticker INTC. Thanks for watching. Bye.